Today, we will talk about holding companies. A holding company is a business entity, usually a corporation or limited liability company. Typically, a holding company doesn't manufacture anything, sell any products or services, or conduct any other business operations. Rather, holding companies hold the controlling stock in other companies. Although a holding company owns the assets of other companies, it often maintains only oversight capacities. So while it may oversee the company's management decisions, it does not actively participate in running a business's day-to-day operations of these subsidiaries. A holding company is also sometimes called an umbrella or parent company. A holding company typically exists for the sole purpose of controlling other companies. Holding companies may also own property, such as real estate, patents, trademarks, stocks, and other assets. This structure serves to limit the financial and legal liability exposure of the holding company. It may also depress a corporation's overall tax liability by strategically basing certain parts of its business in jurisdictions that have lower tax rates. Businesses that are completely owned by a holding company are referred to as wholly owned subsidiaries. Although a holding company can hire and fire managers of the companies it owns, those managers are ultimately responsible for their own operations. Holding companies enjoy the benefit of protection from losses. If a subsidiary company goes bankrupt, the holding company may experience a capital loss and a decline in net worth. However, the bankrupt company's creditors cannot legally pursue the holding company for remuneration. Consequently, as an asset protection strategy, a parent corporation might structure itself as a holding company, while creating subsidiaries for each of its business lines. Holding companies are also relatively easy to create or change. This makes it easy to take advantage of geographical differences in taxation regimes. There are some disadvantages to owning subsidiaries through a holding company. For investors and creditors, it may be difficult to find an accurate picture of the overall financial health of the holding company. It is also possible for unethical directors to hide their losses by moving debt among their subsidiaries. Holding companies can also exploit their subsidiaries, by forcing them to appoint chosen directors or forcing the subsidiaries to buy products from one another at higher than market prices. They may also force subsidiaries to sell products to one another at below market prices. Holding companies fall into different categories, depending on their business operations. Some only exist to hold a single subsidiary, while others may be engaged in other business operations. The different types of holding companies are explained below. Large holding companies may have several income streams, depending on the companies in their portfolio. The most straightforward way to make money is through equity in their subsidiaries. Holding companies can benefit from dividends in the subsidiary's share price, as well as by selling equity in companies that gain value. In addition, holding companies can also profit from synergies between their subsidiaries. An example of a well-known holding company is Berkshire Hathaway, which owns assets in more than 100 public and private companies, including Dairy Queen, Clayton Homes, Duracell, Geico, Fruit of the Loom, R.C. Wiley Home Furnishings and Marmon Group. Berkshire likewise boasts minor holdings in the Coca-Cola Company, Goldman Sachs, IBM, American Express, Apple, Delta Air Lines, and Kinder Morgan. A holding company is a financial vehicle for owning and controlling other assets, such as real estate, stocks, or companies. Using a holding company creates legal separation between the assets and the owners, and reduces the liability for the owners if one of the holdings encounters financial trouble. To create a holding company, you simply need to file the articles of incorporation in the state or jurisdiction where you want to register the company. You will also need to identify the business agents managing the holding and operating companies. This can be complicated, so for companies with larger holdings it is worth engaging a lawyer. A personal holding company is a company where 50% of the ownership stake is controlled by 5 or fewer individuals, and at least 60% of the company's income comes from passive sources. Here are 3 key takeaways. 1. A holding company is a type of financial organization that owns a controlling interest in other companies, which are called subsidiaries. 2. The parent corporation can control the subsidiaries' policies and oversee management decisions but doesn't run day-to-day operations. 3. Holding companies are protected from losses accrued by subsidiaries, so if a subsidiary goes bankrupt, its creditors can't go after the holding company. Hope this would help. Thanks for watching.